Hello, chart watchers, and welcome to this Tuesday, February 13th Market Watchers live show with your hosts, Tom Boley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, it's a pretty interesting day in the market again today. We did see the Dow Jones and the S&P start off earlier today in negative territory, but we are trying to bounce back and move into positive territory. You can see the NASDAQ actually has just moved fractionally back above that break-even point. Russell 2000 continues to lag a little bit, just below that break-even level. 10-year Treasury yield down today, but still hovering around the 2.85% area. The Volatility Index, which moved a little bit higher at the open, is starting to work its way back down toward the flat line. Leading today are the consumer stocks. We have the consumer discretionary actually up today, even though the market is down. And the broadline retailers have been on fire of late. We've seen Target, Amazon, some of those stocks continuing to perform well. The clothing and accessories group, another area within consumer discretionary, having a very strong day today, as you can see, up almost 1.5%. One of those broadline retailers is VIP Shop Holdings, VIPS, having a really strong day today. And this is actually representing a breakout above recent highs, which is unusual in the market here recent days. JCPenney trying to also establish a reverse right shoulder, starting to move higher again, looks good. And Amazon, of course, continuing to move higher and not too far away from its all-time highs. Again, not too bad in this kind of a market. And with that, let me bring in my co-host, Aaron. How are you doing this morning, Aaron?
I'm doing quite well, Tom. Beautiful sunshiny day here in Southern California, as usual. I know it's not new.
And we also have StockCharts' very own president, Chip Anderson, with us. And Chip, you were just telling us it's sunny in Seattle.
It is sunny in Seattle, Tom. Hey, good to be back. Blue sky, looking at clouds. It's cold. It's about 30 degrees, maybe a little higher, warmer, but not much. But that's okay. We'll take the sun. We need the sun these days.
Yeah, it's still a little bit cool in down around the Charlotte, North Carolina area, but I'm looking forward to spring. And I don't see any more in the advanced forecast. I don't see any more days in the 20s right now, which is a good thing. So hopefully I can break out the golf club soon.
I have no idea what you're talking about.
Yeah, you wouldn't. That's not even a conversation we can have. But I know we got a lot to get over, so I'm going to let Aaron take it away for the announcements and today's agenda.
Absolutely. So what's coming up this week? Tomorrow we have Charles Kirkpatrick, author of Technical Analysis, the complete resource for financial market technicians. Julius DeKempener, our RRG specialist and creator, will be in Thursday with us. That'll be great fun. And then Friday, I'm going to do a workshop on bull and bear market rules. Given what we've been experiencing in the market lately, I think this is a pretty good topic to cover. So today, however, we have everything stock charts. As you heard, Chip Anderson is here today to talk to you. Momentum sleepers. We're going to look at a couple of charts where we think something's going on and you should know about it. 10 and 10 to 1. Our first stock symbol is going to be Shake Shack, S-H-A-K, if you want to go take notes. And finally, we're going to finish with a what would you do? So stick around for that. And with that, I'm going to pass it back to you, Tom, for some technical news.
Yeah, it's going to be interesting. And I've got some really cool charts I think everybody will enjoy, and maybe a couple of predictions here. We'll see whether or not they come true. But first, let's take a look at the 10-year Treasury yield. You can see today it is down just barely, less than 1 basis point, sitting at about 2.85%. There's really no economic news out this morning of any significance. So really not a whole lot going on there. And it's reflected really in the lack of volatility in the bond market today. But let's take a look at a stock, first of all, that is showing some volatility. Under Armour, they came out, reported earnings this morning. Their revenues were a beat, $1.37 billion. The market was only looking for $1.31 billion. And they reported flat EPS, 0, and the market was looking for 0, so nothing going on there. But technically on the chart, it's going to be interesting to see how we finish today on Under Armour, because we did make a breakout earlier above the early January 2018 high. We took out those prior highs, as you can see. But we're falling back, and at this point, well off of those earlier highs. And if we fail to make a breakout on the close, we could just be putting in another significant top and what could be more consolidation ahead. So UAA is going to be one to watch. Pepsi also reported this morning. They beat top line and bottom line. The market doesn't seem to care at this point, but they came in with their revenues $19.53 billion. The market was only expecting $19.44 billion. And then on the bottom line, Pepsi reported 31 cents. The market was looking for 30. So we had a slight beat there. But you can see after a lot of selling, of course, the overall market's been seeing this kind of selling. Pepsi did lose a key support, I would say, around the 116 level. As you look back over the last 2.5 months, we had pulled back a couple of times and held that area. But with all of that selling that we saw last week and the Friday, I guess, before, you can see that the selling has taken us below that support area. And the attempt to get back up failed right at about 116 before we continued moving lower. I think the case with Pepsi is very similar to the case with a lot of stocks out there right now. Trying to get back up through a declining 20-day moving average after we got this death cross. For those of you who don't follow technical analysis that closely, death cross occurs when you get a short-term moving average crossing beneath a longer-term moving average. And we saw that not only with Pepsi, but we've seen it with a number of stocks, a lot of sectors. And so getting back up through these moving averages are going to be difficult. And Pepsi, even with a really strong report, you can see not seeing much or getting much headway to the upside. But I do want to talk about something I think is really interesting. And I've followed John Murphy for a long time. His intermarket analysis that he does is something that's really near and dear to my heart as I evaluate markets. And I want to point out, this was something that John wrote about a few months back, maybe a little longer. But he was comparing the Treasury yields in the U.S. to Treasury yields elsewhere around the world. And in particular, I'm looking at the German Treasury yield. So if you wanted to put this up on StockCharts, it's $UST 10Y minus the $DET 10Y. And what this does is it charts the difference between the 10-year Treasury yield here in the U.S. and the 10-year German Treasury yield. And the reason I do that is that, number one, I've done a lot of research looking at the U.S. versus Germany, their equity markets, and they tend to go hand in hand. They have a very tight positive correlation over the years. So it makes sense, I think, to compare their bond markets as well. And what we see and what we have been seeing for the last 10 years is the 10-year Treasury here in the U.S. rising faster than it does in Germany. Now, John Murphy made a really astute point in that sometimes, and getting back to Economics 101, I was always taught that when interest rates are moving higher, that tends to strengthen the dollar. Well, since that time, the market's become much more global. And it's not just about what's happening here in the U.S., but it's also about what's happening across the pond in Europe and around the world, really. So John had posted that if you really want to kind of follow the dollar and what the dollar's likely to do, you really need to compare the Treasury yields, in other words, interest rates here in the U.S. relative to other parts of the world. So I have on the top part of this chart the Treasury yield here in the U.S. minus the German Treasury yield. And you can see, again, over the last 10 years, we've steadily been rising. Now, the dollar also has been rising for the most part throughout this period. But these red shaded areas are times where we have seen the U.S. rates rising faster than Germany's, but the dollar moving in the opposite direction. It doesn't happen often. I even pulled up a correlation here comparing the difference between the Treasury yields here in the U.S. versus Germany and comparing that to the direction of the U.S. dollar. That's what's done here on the correlation. And you can see we are above zero almost all the time. But we have had a few of these periods, one back in 2009, one in early 2014, and now another one that's been building just recently where we are seeing a divergence where you would expect the dollar to rise with the relative rise here in the U.S. in their Treasury yields, but instead we see the dollar fall back. Back in 2009 when this happened, we saw the dollar play catch-up and quickly exploded back to the upside to follow the overall yields. Same thing in late 2013 and into 2014. We saw the U.S. Treasury yields continuing to rise versus Germany, but the dollar took some time off and pulled back. And you can see that correlation factor drop down into negative territory. What happened? The dollar exploded to the upside, took off to play catch-up. Now we're in another one of these situations where, and I really could, maybe even go back to the beginning of, or the end of 2016, beginning of 2017, because you can see that the 10-year Treasury yield is not far from where we were back 14 months ago relative to what's going on in Germany, and yet the dollar just continues to tumble. But especially, you can see that the yield was actually, or the relative yields were dropping here throughout probably the first 3 quarters of 2017, which coincided with the dollar dropping. But the last 3 or 4 months, we've seen U.S. Treasury yields rising faster than Germany's, and yet the dollar keeps weakening. And it's happening with the dollar hitting what I think is a major support level, the dollar index at about 88. Also, trendline support comes right up here at about 28. So this is going to be a really interesting time. And I'm going to get back in just a minute why I think this is really important as we go into 2018. But the first thing I want to do is show you the next chart, which is the Russell 2000. I'll bring all this together in just a minute. But the Russell 2000 has been incredibly weak for the last 3 or 4 weeks. And, well, let's call it 3 weeks. And we've gone all the way back down to test that November low and really a breakout area. So fairly critical price support level that the Russell 2000 broke below at the end of last week on Friday, intraday, but then came back and recovered, which I think is a really bullish sign in the near term. Now, it bounced yesterday. It's kind of struggling a little bit today, down 4.5 points right now. But the reason this is important, let's go back, and now I'm going to add the Russell 2000. Basically the same chart I just showed you. But down at the bottom of this chart, I'm going to show you how the Russell 2000 does relative to the S&P 500 when we get into these periods. So here we are. This is back in 2009, I believe. Yes, 2009. Here is that relative rise in U.S. rates versus Germany. The dollar was struggling, and then the dollar came, roaring back to play catch-up. Well, what happened when the dollar came roaring back? You can see the Russell 2000 here. Now, this, I've put in here the Russell gained 25% in 5 months, which is, I went back and looked at an absolute chart on the Russell 2000, and that's what happened. What this line is telling you is that the Russell 2000 was significantly outperforming the S&P 500 when we were seeing this huge rise in the dollar. All right, and I think that's really important. I'm going to talk about why in just a minute. But here you go. We'll fast forward into 2013 and 2014. Again, we see U.S. Treasury yields rising faster than what we saw, or what we've seen and saw in Germany. And then the dollar was struggling, and then the dollar plays catch-up. Well, we go back down here and check out the Russell 2000. It rose 20% in 6 months and completely outperformed the S&P 500 again during that period. So now here we are, once again, with the Treasury yield in the U.S. rising faster than Germany, the dollar continuing to move lower, hitting critical support that I pointed out earlier. You can see that this inverse correlation, which is kind of odd, has continued to move to the downside. And now we've got the Russell 2000 relative to the S&P 500 hitting a key relative support area going back over the past 14, 15 months. So this, to me, is an area where it's, the pedal is hitting the metal, and we've got the dollar at a major price support area. We've got this divergence taking place. Either the bond market is going to have to, make some changes, and we're going to see the yield start coming down relative to what's going on in Germany to play catch up with the dollar, or the dollar needs to do basically what it did back in 2010 and again in 2014 into 2015, which is play catch up with what's been going on in terms of the bond markets in the U.S. and Germany. It's going to be a really interesting scenario to see how this unfolds. But as long as the dollar holds 88 support, I think it's prudent to maybe overweight small caps, because if the dollar breaks down, you can certainly change that trade. But if the dollar does hold this 88 level and it does start to return back up to kind of play catch up with what's been going on with these yields, as it did in 2014 and as it did back in 2010, then I think we could be in for some significant outperformance in the Russell 2000 as we go forward. So I thought that was kind of interesting. But with that, I am going to turn it over to Chip Anderson, and he's got everything stock charts for you.
Thanks, Tom. Let me get my screen going. And that was very interesting about the Russell. So basically I should go out and buy a bunch of small caps is what you're saying.
Yeah, just don't remember this conversation if it doesn't work, please.
Okay. So today I thought what I'd do is, again, take just a step back. Usually with my everything StockCharts things, what I try to do is make sure everyone's familiar with the mechanics of using the site and some of the key features that we have. I take a look at the customer support queues that we have and what are people asking questions about, what are confusing people, or what's good to revisit that we haven't talked about in a while. And I thought we'd go into, today we talk about overlays. Overlays are super important when creating charts. There's actually several different kinds of overlays, and I wanted to go through those and just make sure everyone was clear on the way that you can add overlays to a chart. Some of this will be stuff that people who've used the site for a while definitely know, but I still think I've got a couple little tips and tricks in here that maybe even the old school people would learn from. So with that, let's go forward. Again, just to clarify, there are two kinds of overlays, and this is important to understand when you start using the SharpCharts workbench. We have an area that is labeled overlays, and I'm going to go over that in just a second. We also have an area that's labeled indicators, but the indicator area can be used to create overlays. A little confusing there. Typically, indicators are the things that are above and below the price point, but not always. In terms of overlays, there are two kinds of lines that you can put on top of price bars. An overlay is something that sits on top of price bars, essentially. And the first one is a technical overlay. That's a formula that's been calculated from the bars and the data of the underlying chart. So if you're looking at a chart of Microsoft and you plot a moving average on top of that, that line has been calculated from the Microsoft data. It's a formula, and that's what's generated the overlay. So those are technical overlays, and they can be placed essentially on any chart. There's no reason that they can't be calculated from pretty much any data set that we have. But there's another kind of overlay that can be very interesting and sometimes very revealing. Similar to what Tom just showed, is the ability to plot a second data set or even a third or fourth data set on top of your price bars. And by data set, I mean a different ticker symbol, a different collection of data. And the data could be related or could be unrelated. We're going to look at that in just a second. But so again, we got moving averages, Bollinger Bands, line study, annotations, those kind of things. Those are technical overlays. And then we've got ticker symbols that you can plot on top of other ticker symbols. Those would be other data sets. So just again, a quick reminder, this is a Sharp chart, and all Sharp charts have a main ticker symbol, in this case IBM. All Sharp charts have a price plot area, which is where, in this case, the IBM bars appear. Overlays are things that exist inside of this price plot area. And again, to clarify, there can only be one price plot area per chart. This area below the price plot, in this case, the MACD, this is a technical indicator. And this is, I just showed it here. I show it here to distinguish it from an overlay. We're not really going to be talking about technical indicators that exist in other panels for this talk. Instead, we're focusing on the things that again, appear on top of the price bars. And then if you scroll down just a little bit on the SharpCharts workbench, you'll see the different areas that we talked about. Chart attributes, we're not going to go over today. Those are big ticket items, changes in the chart. But we're talking specifically about this area here. And then we're also, later, we'll be talking about things you can do in the indicator area to bring in price data sets. At this point, though, I've got MACD shown with a position of below. So this is just a regular indicator. It's not what we're focused on. We're focused on all the different things that can appear here in this drop down. Simple moving average is just one example. One last thing, and if you're new to StockCharts, when you create your charts, you can add up to 3 overlays and up to 3 indicators to a chart. Anybody can do that, even free users. If you're a member, however, and you fill up your 3 slots, more slots will appear. So you'll get more and more area that you can add overlays to. You can have up to 25 different overlays on a chart. You can have up to 25 different indicators on a chart. Again, just fill up the slots that are available and more slots will appear when you click update. Let's see. Actually, I went backwards there accidentally. Okay. So as I mentioned, there were 2 kinds, and one of the kinds was technical overlays. So there are 2 places that you can add technical overlays to a chart. The first is from the overlays dropdown, which I just pointed out, and I'm going to give you a live example of that in just a second. That's how you would add moving averages, Bollinger Bands, price by volume. All those different things that sit on top of the price bars are found in the overlays dropdown. You essentially select the overlay you want, you hit the update button, and it appears. And as I mentioned, 3 slots, you'll get more. You can also do it from our annotation tool, Chart Notes. So there's the concept of things called line studies. And line studies are essentially technical overlays that you have to manually position, interactively position on top of the chart in order to make them appear. So what I wanted to do right now was quickly go over and do some demos of this. I'm going to start by just typing in a ticker symbol. Here's IBM, just to pick one. And to add an overlay to this chart, I'm going to come down here. Here is our list of all the different overlays that we have. And we have a bunch. There could even be more that we could add, but this is more than enough, really. The key ones, again, as I mentioned, Bollinger Band, simple moving average. We have simple moving average itself right here. Exponential moving average is here. There's also simple moving average envelopes and exponential moving average envelopes. Parabolic SAR is one of my favorite, and maybe my most favorite would be volume by price. But for now, I'm just going to keep things really straightforward. Simple moving average of 50. Let's also add a simple moving average of 200. By changing the parameter here, we get that capability. And then we just hit update. Here we have our stuff. We can see the cross. We can see the values over here in the legend. That's how overlays work in general. The other thing, though, that I wanted to mention was line studies. And line studies, again, are part of our annotation tool because you need interactivity in order to add a line study to a chart. And so by selecting the chart and then selecting you can select trend lines are an example of a line study. So we just draw one here, position it. In addition, you've got line studies here, such as Fibonacci retracements, cycle lines, and maybe the RAF regression channel is one of the better ones. You can pick. A line study is unique because you have to basically select a starting point and an ending point. You do that by clicking and dragging. That's what I've done here. I'm dragging my mouse out. And the RAF regression channel is using the data on the chart between the two areas that I started and ended my drag to calculate this particular value. So that's an example, again, just of an overlay that's a line study. There's a lot more about chart notes that we'll talk about maybe at some other episode. So I'm going to say, no, let's not say that one. Come back here. Let me go back. So again, overlays and line studies are technical overlays that can be calculated on any data set. The other category of overlays are where you're putting a different data set on top of your first one. And here's the main thing that I wanted to get across. Everything I've told you up until now is really kind of preparing you for this. We have 2 different ways to put data sets on top of one another. The first is to use what's called the price same scale overlay, and the other one is to use the price indicator. And so I'm going to show you the difference between those 2 things. When your data is related, in other words, it's on the same scale, then you want to use the price same scale overlay. This is not normal. Well, it's not typical, I should say. There's a lot of data that you'll be overlaying or looking at. It's typically not related, and it typically doesn't belong on the same scale. So an example would be if you're looking at, say, the advanced decline line and the New York or the Dow. So the Dow is on a scale that goes up to whatever, 20-some thousand. The advanced decline line might go above or below 0. And if you plotted those 2 on the same scale, one line would be way down at the bottom of the chart, the other one would be way up at the top of the chart, and you wouldn't be able to really compare the 2. So because they don't really belong on the same scale, you would not use this technique to do it. Instead, you'd use the second technique that I mentioned below, unrelated data. But if they were related in some way, and bond yields are the perfect example, they were actually the reason this feature was added. There's other ones, but bond yields is one of the classic examples here. You would want to plot them on the same scale. So for instance, if we wanted to compare these four major bond yields on one chart, we could create a chart with UST2Y as the main symbol, and then we could add the other three symbols using price same scale overlay. And if we did that, here's what we'll get. Let me go back here. I'm going to go back. And I've created the chart here ahead of time. So this is what that chart would look like. And the key here is they're all using a single vertical scale over here. And so the value of each one can be directly compared to the value of the other one on this chart. And you can, if there are any crossovers, those are totally valid. If there are any, as they get closer or separate, you can see all of that very easily on this chart. So this chart was created, again, notice, by using price same scale here in the overlay area. Okay. Just to give you an example of the other way to do it and why you don't want to do it in this case. If the other way to do it is to add a price indicator and change the position from below to behind price. Okay. But if we do that, and we can even do that for something like US, well, just UST, and we hit update, what are we going to see? Well, here's the UST line that we added. It's this blue line, and it's going kind of all over the place, which is fine. But we're not seeing, all right, I have to change one other thing. There we go, turn volume off. Okay, but we're seeing some crossovers here, and we're seeing situations where it looks like these two things have gotten very, very out of whack. But what we have to remember is that this UST line is on this scale over here, going from 120.5 up to 127.5. Whereas the rest of these are still down here going from 2 to 3 or somewhere in there. They're on completely separate scales. There's no relationship between these two symbols. And any conclusions we drew, for instance, where this crossed over that one, would not be valid. So again, you want to basically, I'm going to turn this one back off because it's confusing. You want to essentially remember whether or not there's a relationship between what you're charting and what you're not charting. Let me quickly go back and I'll show you the other example that I have for you. Here's another example of unrelated data. Let's say we're interested in the relationship and the correlation, if any, between IBM and Microsoft. So we're going to chart IBM, and then we're going to use that price indicator I just showed you with Microsoft as the price indicator parameter, and we're going to use behind price as the position. But again, as I say here in the warning, at this point, crossovers are going to be meaningless because they're on different scales. The chart is still useful, but it's on different scales. So let's see what this looks like. So here's my example. I've quickly created it ahead of time. And so I've added, as you see down here in the price indicator, Microsoft with the behind price position, and its color is green. So we can use this chart to see how the two move together. So when one starts moving up, does the other move up as well? When one starts moving down, does the other move down as well? When one's hitting a new high, is the other one hitting a new high? All of those things are valid. What's not valid, though, are these crossovers. When this green line moves above the blue line, does that mean that Microsoft has had something significant happen? Not because those things cross. The fact that they're crossing right here is a visual coincidence based on our automatic scaling of the vertical bar here and the vertical scale here. And to prove that, if we go out, hope this works, if we go out and look at it like a 3-year chart of this stuff, the crosses now are happening in different places because the vertical scales here have been changed. Again, the scales are just based on our automatic approach of trying to get as much vertical highs and lows onto the chart at the same time. So hopefully everyone remembers that those don't matter. The chart is still useful, but you have to be careful. So anyway, you can use the price indicator to overlay any ticker symbol you want here as a parameter. Again, it can be another stock, it can be a market breadth indicator, it can be another index, so on and so forth. So I think that actually is kind of wrapping things up for me. Again, lots of different possibilities when people talk about overlays, and so I wanted to cover the basics, make sure everyone was clear on them. Did we have any questions, Zach? Or Aaron or anybody else? No?
Yeah, I just
go ahead.
I was just going to kind of add on one thing, because I use these overlays and I use the correlation factor quite a bit. And I think the other thing that you just have to use is common sense sometimes when you're comparing two symbols. I mean, earlier when I was doing the correlation and looking at the difference between the U.S. Treasury yields in Germany, the Treasury yields in Germany, comparing that to the dollar movement and how that might impact the Russell 2000. I mean, those, you can make some sense out of why things work the way they do. If you're, pulling up on here the fact that coffee prices rose 20%, and you noticed at the same time that Amazon rose 20% as well. I don't know that that would necessarily be a great conclusion to draw, that Amazon and coffee prices are going to go up, hand in hand. I think some of it does come down to just using common sense and what should happen, and then using some of these tools that you're showing, Chip, to kind of, I don't know, make it just kind of confirm maybe what you were looking at. I don't know if that makes sense, but anyway, I use it a lot in that sense. I try to use the correlation, but I want to make sure that it's just a common sense comparison.
Yeah, and I've talked in the past, and I think we agree, Tom, that when you're just looking at two things and you want to compare their performance, something like a ratio chart might be a better way to go than plotting both of them on the same chart, but it depends. And so the point is the tool's flexible enough to do everything. I wanted to make sure today that everyone understood the difference between price, same scale as an overlay, and price as an indicator.
Yeah, and we did have a question. I know the answer is likely no, but can you add yet a third unrelated data set, and what scale would it use? Well, I think that's the problem. Am I right?
No, it's not a problem at all. You can add, members can add up to 6 data sets to a particular individual chart. I think pro members can add a couple more. And they will just all overlay. What you won't see is you won't see an additional scale, the vertical scale. We can only show one on the left and one on the right. And so anything that you add beyond the second data set, you won't see the vertical scale for it, but it will still be plotted again in an overlaid manner so that we maximize the vertical, the highest. Make sure the highest high on the chart shows and the lowest low on the chart shows. And again, it means the crossovers aren't meaningful, but you can still get a sense of the direction of the indicators and whether they're moving together as a group or diverging at all.
Excellent.
All right.
All right. Well, thanks, everyone.
Okay. Appreciate it. Thanks, Chip, for stopping by. And I know that hopefully helped cleared up some issues that maybe subscribers are having using the overlay feature. We do talk about it quite a bit on here. So, as questions come up, feel free to pass those along. You certainly could do it here in the chat box, or you can do it in the survey responses, and we'll try to address those questions that you have in future shows. But very, very good segment. Thanks a lot, Chip. All right. Well, Aaron, I guess it is time to move on to the momentum sleepers. So I'm going to let you take this screen and show us what you got for today.
All right. Sounds good. It's really been difficult to run these scans. I mean, I'm not going to lie. There's not really that much positive momentum going on here. So I think it's important that we look at the fact that we can't get everything we need. So right now. So anyway, I wanted to show you what I do have so far. And these would be right in, oh, I put them right there so I could get right to them. So I had 5 today. And I will say that Cody, which was my Monday setup, re-showed up on my scan. I chose not to put it in because I talked enough about it yesterday. MC was also, I noticed that was also part of my Monday setup group, but I'm going to show you that anyway. The scans I ran, I was trying to mimic what I did, but I couldn't remember exactly what I did to get those particular stocks. But what I end up doing is when I'm running a scan, for example, and let's see, I think this one, let me see, one of them came up with just like 100 and something entries. Now that wouldn't be it. But what you can do is when you get a ton of entries on a scan, when you're going to see a huge amount of results. Oh, that's not going to work because I know that was on the other one. But one thing that you can do if you do have just too many is you can go in. Actually, I know somebody was telling me about, here we go, the scan that I consider to rule the world of all PMO scans. Somebody had mentioned about changing the hot zone here or changing the scooter. Or for me, in some cases, I simply, if I need more results, you can always comment these out. So just add your double right there. And now that's not going to be considered when you do the scan. So admittedly, I've had to kind of change some of my parameters just so I can get a group for you to look at. But I certainly wouldn't present anything that I think is, just for the sake of presenting it. But I thought these came up and I really did like most of these setups. And one of the things I noticed when I had it in the summary view is the fact that a couple of these are having some very big down days. And I think that reflects opportunity when I go in and see some good setups. So let's go ahead and get started looking at some of these momentum sleepers. So Buckle is the first one. And I know the PMO is starting to sort of tip over. I was using the scan based on the close from yesterday. So we might see a little bit of activity like that. And not a surprise when you have more than a 1% drop. But what I was looking at actually was this possible double bottom that's coming in off of this big decline right here. And so if you looked at, obviously, the length of that pattern and were to add it to the top, certainly a pretty nice turnout. I like the fact the scooter is still strong. OBV is rather flat, but I thought this one was interesting in that it has, it hasn't been able to get above that overhead resistance, but it really wants to. So that's why I wanted to include this one. Diodes Incorporated. And here we go with this one. This one had a really nice positive divergence with the PMO bottoms. And I haven't been seeing that a lot lately. So I thought that was pretty interesting that it came up. And now we can see today we're actually getting that PMO buy signal crossover. So it's sort of hard to see, but we have a symmetrical triangle here. And it's coming off of a gap up that I would say could be, a breakaway gap. This doesn't look like an island. Obviously, we've had way too many volatile moves here. So in my opinion, I don't see an island, but I do see a symmetrical triangle, and that could very well break to the upside. And given this nice looking momentum that's starting under the surface here with the divergence, I thought this one looked very interesting. The 50 is above the 200 as well. So I feel like it's still in that bull market configuration. So I'd be looking for a move, to test this area of resistance here at about 30.50 or 31. And as far as a stop is concerned, I'd probably have it rather tight. I've kind of tightened up most of my stops right now just because I'm not really happy with the market action. Just feels toppy again. So I just don't, this rally coming up now, it's just not, I'm not seeing it yet. So I don't want to get totally out there and lay my cash out. So what I'm showing you are the ones I think are interesting, but I'll be honest, I'm not jumping into anything. All right, GPI, Group 1 Automotive. This is a very low, this is going to be a volatile stock. As you can see, we have pretty low volume on it. But again, I saw a positive divergence. And look at the OBV. We're getting a breakout from this declining tops on volume. So I thought that was pretty interesting. The scooter is still in what I call the hot zone, which is nice. Look in the thumbnail, and we have a flag formation here. So I think this one looked pretty good. And again, I would probably tighten, have a fairly tight stop, maybe at that 200-day EMA. But I think the upside target for this one looked pretty good. This one I did talk about yesterday, so I'm not going to get too far into it. But again, we've got really nice momentum moving up here. And look at the OBV. We're now getting kind of a breakout. Well, of course, mainly because we're getting a lot of volume in here on this move up. So flag formation possible. You can see we already have that breakout. Currently, we're above this overhead resistance area. I believe it was the weekly chart on this one. No, it wasn't this one. But, you know, we've still got an PMO on the weekly chart that's rising. USA Technologies. And this one has a nice breakout from that declining tops trend line, and it's holding it as support. You can also see that 20 managed to avoid a negative crossover. You have a PMO that is rising, and you know, I think this one looks pretty good as far as, you know, your upside target's about 10, and you could have a fairly tight stop, I think, at that 850. Maybe you might want to go to the 824 level. It's just a matter of your risk appetite at this point. But I thought that one looked pretty interesting as well. And I know one of these had a really interesting weekly chart, and I'm very angry with myself that I didn't make a copy of it, but I thought these were pretty interesting as far as momentum sleepers are concerned. So yes, this one, I noticed that overhead resistance is still way up here at about 8250. So there's definitely some good upside potential on that target. But yes, PMO sell signal on the weekly chart currently showing, but I think for the shorter term, I think it looks pretty good. Right there. And those were the momentum sleepers that I found. I think you were going to look at some industry groups, Tom.
Yeah, I'm going to take a little different angle. Just going to take a look at what the different areas of the market that I think are setting up pretty nicely, especially if the market does resume at some point its move to the upside. So I thought first thing I would do is start off with the XLY relative to the S&P 500, just so that you have a sense of where I'm coming from. The consumer discretionary group relative to the S&P 500 for about 20 months really struggled. If you look at the chart of the XLY, it continued going higher. It's not like the consumer discretionary went down. It's just that it wasn't going up nearly as fast as technology and the industrials and the financials and so forth. So it was just lagging for a while. Well, that all changed over the last 3 or 4 months, as you can see on this relative chart. And over the past 3 to 4 months, there's no area that has been better than consumer discretionary. And I know earlier today, consumer stocks were leading again. We had both staples and discretionary. I think discretionary was in the #1 spot and staples #2. But I think the backdrop is that things have changed. And so we've got consumer discretionary that has been outperforming for some time. So when I now look at the market, some of the areas that I want to consider are areas that are either beginning to perform well within consumer discretionary or have been performing well and have simply pulled back recently. So that's how I'm going to describe these momentum sleepers. #1, we got discretionary stocks, which have been absolutely on fire. And we're looking for either groups within discretionary that maybe haven't participated and are just starting to, or groups within discretionary which helped lead this advance but have pulled back with the overall market. So just kind of keep that in mind. Now I'm going to go into the media agencies, which is the dollar, DJUSAV. I'm going to bring this chart up, but I want to show it relative. And so let me go down here and bring up the price indicator. And I want to show it relative to the XLY. So I'll do the $DJUSAV : XLY. And I'm going to move it up. I'm going to make it a big chart. Okay, let's take a look at this. Okay, so when I pull up the media agencies, and it's just, I've got line charts on both, so don't be too concerned here. But one of the things I'm watching for with this media agencies, and this is one of the areas of the market that I talked about in my 2018 forecast, that I thought, you know, it's been underperforming for a while, and it could just be beginning to make a pretty significant move to the upside. And you can see here we've climbed back up above the 20-week moving average, which I think is important. We fell just briefly below it. Now we're right back up above it as well. And we're starting to see the relative strength pick up. Now, we have been in a relative downtrend for a while. So if this starts to roll back over in terms of price action, I would ignore the group. But if we continue to strengthen, especially if we can get back up above, I'm going to change this and let's put the candles in here. But if we can get back up above these highs, 585, 590, clear that 50-week moving average, which is at 585.80, and then that 20-week starts to curl up from underneath. We get a breakout above that center line resistance. I think this is a group that you will start to see show a lot of relative strength. So this is one I'm keeping pretty close on my radar, just watching, not really trading any of the stocks in this space just yet. But we saw similar setups going into 2017 in the renewable energy area, where it had been underperforming for 2.5 years and then finally started to make the break, and it was the best performing group in 2017. And then also home building, home construction index, which had just languished for about 2.5 years going sideways, made a big breakout early in 2017, and that was the second best performing group. So you really want to try to catch these early, and I think that the media agencies group is one to keep an eye on. Now I'm going to go through a couple of others. Let's take a look at the gambling index, DJUSCA. This one has been, now this is a group that has been performing well now for the past 2 years, continuing a very nice uptrend. Notice we've pulled back on the weekly chart, and we're now testing that rising 20-week moving average that has provided some great support in the past. Over the last 2 years, we've probably only seen maybe a handful of weeks where we've closed below that 20-week moving average, and we're sitting almost right down on it now. We have outperformed the XLY over the course of the last 2 years. Hasn't been a huge outperformance, but it did stop this relative downtrend where the gambling stocks were performing very poorly for quite some time. And now we are at least moving higher, and we're hitting some key support. So I think gambling stocks look interesting. The clothing and accessories, this is a group that really looks strong to me. Again, on an absolute basis, the group was under pressure for over 2 years, maybe 2.5 years. Finally, we broke, and look at the rising 20-week moving average holding. So when you look back, and I'm not going to go back and show it again, but media agencies were kind of like in this stage. That's where media agencies are now. That's where the clothing and accessories were, 6-8 months ago, just starting to show some strength. And if you take a look down at the bottom here on a relative basis, just starting to turn up. And now what we've seen is a group now that is starting to lead. We are now at a relative high relative to the XLY dating back over a year. So we're at a 1-year relative high now in clothing and accessories. And you can see that the price action has been very strong, holding on to rising 20-week moving average support. Two more I have here. One is footwear. I think footwear is another group to really keep an eye on. On a relative basis, look at the triple top here, actually maybe quadruple top. And we have strengthened. We've made a breakout over some serious long-term sideways consolidation. We've pulled back. We've held that rising 20-week moving average. I think footwear is poised to move higher, and it's on the verge of a major relative breakout as well. So I think footwear is definitely a sleeper in terms of momentum and an area that I would continue to watch. And then the final one that I have is the DJUSRQ, which is recreational services. This one's been slowed a little bit on the chart here by a negative divergence. As we kept moving higher, it just seems like it was running out of steam in terms of price momentum. So maybe we get a little bit more consolidation. But notice this was a group that was heavily outperforming the XLY dating back to the third, fourth quarter of 2016 all the way through the end of the third quarter of 2017. And then this sideways action actually showed relative underperformance. But notice we're starting to turn back up again. We're holding this rising 20-week moving average. We've been consolidating. I think the weekly PPO is getting closer to centerline support. I think this is a group that has been somewhat under the radar and sleeping a little bit lately, but look for perhaps another breakout coming up soon on the recreational services group. So those are the 5 groups that I was interested in showing. If you're interested in trying to find, okay, well, you showed industry groups. How do I find stocks within those groups? Well, let's take recreational services, take one quick look, say, at the sector summary. No, actually, I don't want to do the sector summary. Let's look at scooter reports. And you could bring up large cap stocks. You could sort by industry and then just simply go down and find the industry group. And if you sort it actually by the scooter and then by, let's do this again, sort it by the scooter and do it by industry group. Then when you're looking at an industry group, it keeps that sort in scooter order as well. So you can find the industry group that you like and then look for some of them with the highest scooter rankings among large cap. And you could do the same thing with mid cap and small cap. But with that, I'm going to turn it back over. I know we got an announcement, and then we'll get into the 10 and 10.
Absolutely. So first of all, let me go ahead and share my screen for you. We do have Charlie Kirkpatrick, Charles, coming in very soon, tomorrow, actually. And so I wanted to give you guys a quick look at where you can find his book, if I can ever share my screen here. All righty, let's drag in. I do not know why it does this.
Well, it's given everybody an opportunity
There we go.
to look at some of the sleepers that we had.
Absolutely. So what I wanted to show you, if I can get back over here, is where you can go and get Charles Kirkpatrick's book. It's currently in the StockCharts bookstore. You just go to store.stockcharts.com and go ahead and search on Charles Kirkpatrick, and this is going to come up. And I highly recommend it. I actually have the second edition, and now that I see there's a third edition, I might be.
Hey, Aaron, I'm not seeing. I'm only seeing your screen that shows Apple and some of the other.
Goodness. I don't know why the screen sharing has been so difficult lately. It doesn't make sense to me. All right, well, I'll just go there from here.
There you go.
All right, let's do it that way. All right, so I'm going to go over here to StockCharts, and you can just scroll down to the bottom, and there is the StockCharts store. Charles Kirkpatrick right here. Hey, look, I looked him up lately. And this is the book that he did right here. And again, I highly recommend it. I know that I love John Murphy and Martin Pring's books. I think that those are top of the list, but I would add this one as well. It's very easy to read, and it is used by the CMT as part of their CMT program, their certification as a chartered market analyst. So I think it's a great book, and they do too. So one thing to look at. And then finally, at stockcharts.com/ChartCon. We have all the information about ChartCon 2018 that is coming up. It is a virtual conference, so all of you watching the show, I could tell you right now, are probably going to want to do this. It's the same idea, and you'll be able to watch us live, but there's also the opportunity, of course, to come visit us and sit there live with us as we present, front row seat, dinners, and you get to rub elbows with all of us. And this is currently the agenda you can look at to see all of these amazing guests that we're going to have and featured presenters. There we are. Oh, there I am. Okay, so that's what I wanted to cover off before the 10 and 10. But Tom, you ready? We'll go ahead and hit that.
Let's go ahead. Did you want to show an RRG, or do you want me to just take it?
Oh, yeah, I do have that. Look I have it already, in fact. So these were the 10 and 10s that I got from everybody. And I usually like to look at our RRG just to see what the outliers are, or what's interesting currently. And we've got 3 that are now in the leading category, as well as 5 of these that are currently considered leading and strong. So the improving is what we want to see. Mostly, but there's obviously some interesting information in these, so don't worry. I'm not just picking the symbols based on the RRG, but I thought that was interesting to look at. So let's go ahead, and we're going to start with the first one, which is actually in the weakening category, Shake Shack.
Yeah, it definitely has been weakening. I mean, the overall market, of course, has been getting hit, but you can see here on Shake Shack, after putting in triple top and we had an actual pretty nice breakout, closing at new highs on heavy volume, and that always makes you a little nervous. I think when you get that breakout with a negative divergence and you can't hold it, that's a little bit of a warning sign to me. But we've been continually moving down. I think here on this chart, you can see that the declining 20-day moving average is probably the first area of resistance that I would look for to the upside. Today, we are hitting a key area of support, and we're bouncing off the lows. I think if we could print a hammer, something like that, that may be a nice little short-term indication of a move back to the upside. Maybe we can get up to 40.5, 41. That's what I would be looking for. I don't know that I'd look for a whole lot more than that here in the near term. Let the market show us that things are starting to improve first. But I do want to respect that declining 20-day moving average to the upside. If we weaken later in today, the volume's been heavy. So if we don't finish, if we close below this support level, I think we're probably looking at another couple bucks to the downside, where we've had multiple tests down around $36. That would be where I'd look next.
All right. Let's see. Let's do the next one, PZZA. Since we've looked at shakes, let's look at pizza, I'm thinking.
All right. Yeah, sounds like a pretty good diet here. Nice diet of stocks. Well, I mean, it's been downtrending for quite some time. I think you can tell looking across here from November to now, we've gone down to about the $56 level on multiple occasions. We had a huge bounce here. This is kind of disappointing, I think, that we've seen Papa John's pull all the way back down to 56 after breaking out on very nice volume. I mean, I know things have been bad, but you would at least have expected maybe that 20-day or even the 50-day to hold. And yet we sold right back off and went back down to this support level. So I think it's just beating on this support door. And eventually, I believe we're going to fall below it because this has been an underperformer on a relative basis. If you go all the way back to the latter part of 2017, this is a stock that's been declining. And with the exception of this one move, maybe over a course of about 5 or 6 trading days, this is a stock that's been downtrending and just keeps beating against support. So I would be careful, especially a close much below 56, 55 and a half, that area. If you see volume coming in, I'd be careful with Papa John's. I'd be out of the stock. All
right. Ever popular Nvidia, NVDA, of course.
All right. Nvidia. Well, Nvidia continues, I think, to perform pretty well considering. It's in a trading range, but a nice move off the low. We got down below 205, rallied almost all the way back to 240, and that was with earnings. And now we're settling back down in between. I think we're in a trading range now, and I think that's true really with the overall market. For a while, the market was moving up. We didn't really have any overhead resistance because we kept breaking out to all-time highs. Well, now we do have overhead resistance, and I think Nvidia is kind of along the same lines. It was an all-time high territory. But you can see with the move up just above 245 in this 245, 250 range, we saw selling and the selling escalated. So I think now as we move higher, we're going to continue to see some sellers up in that area. To the downside, gap support and recent lows, both at 204, 205. And this came on very heavy volume, and we got a lot of buyers coming in at 204, 205. So that's the area I'd watch to the downside. We could probably draw lows coming across here, rising bottoms that would intersect somewhere in this range as well. So I personally would trade Nvidia in this trading range for now, 205 to 245.
Okay. Next one is Mexico Fund, which is MXF.
All right, MXF. Well, this is just, I don't know if I have enough data here. I'm going to go back a little further. Let's take a look at 10 months. Yeah, it's, we had the downtrend. We rallied back. Now we're heading back down again. We've broken the rising bottom trend line that we had. A little bit of a neckline here at 1580. So let's just draw that in there because I think that would be my line in the sand. After rising off of this triple bottom, we pulled back. That was a reaction low. We moved higher. We've come back. We've tested this area. So maybe right in the 1570, 1580 area. That needs to hold for me. Again, I'd be careful if it breaks down below that level.
All right. Let's see. The next one we will do is waste management, and that's WM.
All the way back down to price support, and I've seen this on a number of stocks where we were putting in higher highs, higher lows, and then we go all the way back down to that previous low or the previous breakout. And I think it's pretty clear here on waste management. Huge breakout, heavy volume, went down. We tested the breakout level, went to new highs, and now during this selling, gave back all of this advance. And in the course of, 2.5 weeks, gone all the way back down. I think 79 is a pretty good level. You've also got a little bit of gap support, top of gap support sitting at 78. And that's where we've seen these big reversals come in on heavy volume. So I'd continue to watch 78, 79 as big support on waste management.
All right. And more food, making people hungry. Hershey Foods, HSY.
Oh, and we got Valentine's Day tomorrow. Perfect time to look at it, right?
Exactly.
All right, HSY. Well, chocolate must not be in favor this year. And I think it's interesting, too. I believe that Hershey's does well in February. I'm going to have to pull it up seasonally in just a second. But you can see that the price support that was established here back in late October has failed. That was about 102. And it wasn't light volume. And we had a big red candle, went right through that area. So a bounce, I would be watching a combination of price resistance at 102 and this declining 20-day moving average, which is now down around 104. That is your area of resistance, in my opinion. Maybe even go up to the gap resistance at 105.5. So 102 to 105.5, major area of resistance, I think, going forward on Hershey's. And to the downside, well, I mean, we've broken below recent lows. I'm not a fan. I'm looking for stocks that have pulled back, but I'm not looking for stocks that have broken back to, multi-month lows. So I would avoid. But I do want to take a look at that seasonality. Let me pull that up real quick. I mean, maybe I'm just not remembering this correctly, but I do think that there was a interesting seasonality in February going back many years. Yeah, over the last 20 years, look at February. It's been up 90% of the time. So that history is going to be challenged with what Hershey's doing so far in February. But 90% of the time it goes up, and you can see also the average gain per month. February's is 3.8%, much higher than any other month of the year. But February doesn't seem to be saving that chocolate maker at this point.
Okay. Let's see. The next one are Copper Miners ETF, Co Px.
All right, COPX. I mean, I haven't been a fan. I do think we got overbought in the near term, or excuse me, oversold in the near term. You can see the RSI dropped down to 30. So I think we're getting a bounce. But the key area on COPX, I think, is approaching. And so let's draw in the prior double top highs where we had broken out above those back in late December 2017, kept rising. At the top, false breakout, negative divergence, back down, and we went below price support. I didn't like that, and the moving averages. Now take a look at where we are with moving averages and resistance, all coming together between roughly 20, let's call it 26.75 and 27.25, in that range. So we've gotten a nice rally off the recent low. I think we need to try to negotiate this area of resistance, though, and until we do, I'd be skeptical of this move back to the upside.
All righty. Next one I have for you is Textron, TXT, in the aerospace industry.
Yeah, another one that unfortunately put in a shooting star candle with a negative divergence. I mean, if you ever looking for reasons to sell, if you're a short to intermediate term trader, to me this is one of those reasons. It's actually, I like to use the pink there, and you see slightly lower PPO, higher price, and there's your reversal. See that long tail to the upside? Got up over 62, was going off to the races, and then reversed. So you got your reversing candle and a sign of slowing price momentum. That is usually not a good combination and probably worthwhile at least taking something off the table at that point. We had been holding the rising 20-day moving average, but after that slowing momentum issue became apparent, we lost the 20-day, went all the way back down. We do have support, though, just below 56, and we hit that and bounced. We actually, it looks like, went just a little bit below. Nice uptrend, little cup, handle, breakout, went all the way up to 62, like I said, and back down to test the breakout area of that cup. So 55, 56, great support here.
Okay. Number 9. There was a lot of talk about this ETF, the China Large Cap ETF, FXI.
All right, FXI also coming all the way back down to gap support. I think we're likely to find a bottom either at gap support or the most recent low. So let's take a look. There is your gap support, and you can see essentially a doji with that long tail. Looked like it was breaking down, came all the way back up and closed right on the bottom of gap support and trying to hold. Now, if this fails, then I'd be looking at the next low. Uptrends they consist of higher highs and higher lows, and so far that pattern is still in play here. This is the critical level for me, 43.5. I think short term we could hold here. This would actually be better because then you have rising lows, which I prefer. But if we do fall below the 46 level, look for 43.5 to be major support on FXI.
Okay, and then our last one, TBT, which is the ProShares Ultra Short for the 20-year treasuries. I know I'm pretty bearish on the treasuries, but I generally stay away from these sorts of funds.
What was the ticker?
TBT.
Oh, T. I thought you said P.
Nope.
Okay, TBT. Well, again, you're talking about an ultra short, so you're talking about juiced or leveraged ETFs. I don't like using the technicals on these charts. I would prefer to go to the underlying index. So we could go look at maybe the TLT, or
Sure.
this is the ultra. Let's pull up the TLT. So just keep in mind what we were just looking at is the inverse times 2 of the TLT. So the TLT moving down did make a big breakdown of a topping head and shoulder pattern. It has not made its measurement yet. I think it could go, probably another 121 to 128, down to about 114 or so is what I would be using maybe as a target on TLT. The problem here is we could get a bounce at any point in the TLT. So if I was trading the TBT, I would wait until you get that bounce. Notice how each time we get up close to this 20-day moving average, that seems to be the time that you would want to be shorting the TLT with using the TBT. Here, we're very, very oversold on the TLT. Let's get a little bit of a bounce. The closer we could get up to this neckline, 120, 120 and a half, I think the better your TBT will line up. So going back to the TBT, let's annotate it. And essentially what should happen is if we get a bounce in the TLT, then this TBT should see a decline. And as the TLT hits its 20-day moving average or gets close to it, the TBT should be pulling back and also getting close. If I was going to trade the TBT, I want to do it when my risk is close to a minimum. And I think the closer you get it down here to the rising 20-day moving average, the better you can control your risk on this trade.
All right, and that concludes the 10 and 10. And here were the symbols that we looked at, and I will get those posted to the Market Watchers Live blog, which has the link to our Market Watchers Live chart list, and you'll find these with all of those annotations right there by the end of the day. And with that, it's time for a market update. So hopefully my screen will allow me to share. Let me know if you see anything.
Yeah, I'm still looking at the symbols.
Yeah. All right. Well, let's try this way. It is so strange, really. I do not understand why this happens. All right, let's start.
One of the mysteries of the internet.
The mysteries of the internet, indeed. Here we go. Try again. I'm sorry, Mr. Producer. It's just not working. Hey, why don't you pull up the candle glance for me, Tom? I'll take a peek at that until I can get this thing to share.
Okay, let me just grab it here.
And then we can at least take a look at that.
All right. We're going to get there. Okay, so let's go down here to candle glance. It's pretty quick how you can just hit that candle glance and all of a sudden see 12 charts that can summarize the market for you.
Oh, I know. It's very, very handy.
Give you the 2-day. So you can go ahead if you'd like.
All right, let's look at this. I'll try and get this thing off of my screen so I can see yours. All right. So as we can see here, honestly, the markets have been trading rather flat, but in the negative. You can see the S&P 500 did make a move to try and get up above its close from yesterday, but that was overhead resistance. It's heading back down now. I think it's interesting to see that we've got technology sitting in the same position, but higher. It really wants to make a move to the upside. Russell 2000 had an interesting morning, but now is starting to consolidate just under yesterday's close. Wilshire 5000 looking pretty much like the S&P 500. We can see that Treasury yields are down slightly. And look at UUP, big old gap down, but is now consolidating along its intraday low. Commodities had a very difficult morning, but have been on a nice rising trend and likely probably helped along by USO and oil, which is now finally getting itself up into positive territory. We can see that gold has formed a flag, and it does look like it wants to break out of that and move higher. And as far as the short term, I think it looks pretty good right now. The VIX is, kind of maintaining here. We're now at, considering what we've been seeing, 26, 28 is a decent mid-range at this point. We really haven't gotten back down to those 9s and 10s, and I don't expect we'll see that for a while. And as you can see, declines are leading advances slightly from yesterday. And with that, I'm going to close it off because I know we have a lot to cover on what would you do. I just wanted to give everybody an idea of what everybody is seeing right now in the market and make sure that you knew.
Yeah, so. I just wanted to mention that volatility index still scares the heck out of me at 26 and change, by the way, because anytime it's elevated, if we start to see the market roll over with a VIX at this level, first of all, the VIX is going to start rising again if the market starts to roll over later. I was watching the S&P 500 around that 2620 level, which was the low from yesterday. And if we fail, to hold on to yesterday's low and it looks like we start to roll over again and the volatility starts to pick back up again, we could be in for another one of those, swift moves to the downside anytime that VIX is that high. So anyway, just wanted to mention, like you said, it's still sitting up there. And I agree with you. I don't think we're going to see 9 or 10 anytime soon, but I would like to see this move back down into the teens, over time as the market just settles back down. I think that would be a positive, but we'll see.
Absolutely. I'm still trying to share. So when it happens, I will know. But I figure I need to keep trying so I can hopefully eventually get to that what would you do segment.
Well, I can show the forward chart.
Yeah, go for it. I had just some great annotations and everything I really want to show. So hopefully I can get this thing too.
Okay, well, this is what we're looking at.
I got it.
There you go.
Okay, I'm going to take it while I have it.
Magic.
Okay, and of course, I think I shared the wrong thing because I want to go to my forward chart, which is in Safari. Can you see that?
I got the bookstore.
Yes, perfect. Oh my gosh, I'm so excited. Okay, so let me go to what I was looking at for Ford. So the question is, what would you do with Ford? Would you buy or hold it? Bullish, basically, or would you sell or short it at this point? And I have no idea what Tom's suggestion is, so I'm just going to lay out what I'm seeing. And I know it's been playing. We were joking about GE and Ford, having some difficult times, but I think I like Ford. I actually do, and there are problems, technical problems on this chart. I'm not going to lie. Got a 50 getting ready to cross below the 200. But interestingly, that's at, I think, a really interesting, what was support and is now overhead resistance. What I would be looking for, we got this bounce off of some pretty serious support here. The PMO is starting to decelerate and it really wants to turn higher. I like that we've got higher bottoms on the OBV, and you can see we're going to end up with higher top already in the short term. So I like that. Scooter, not so exciting. Let's go ahead and look at the weekly chart. And this is why I just think there's some potential here. I know it's been in a free fall, but it's right here on some really, really strong support. And the fact that it's low enough on that, it's high enough above that support level, having come off of it, that I really like it because I think you can reduce your risk because you can set your your stop a little bit tighter here because it's closer to that support level. Yes, intermediate term could be an issue. We do have a PMO sell signal here. I'm just, just looking at the chart. I highlighted this because this was a long-term descending triangle, and those are bearish formations, and we got a bullish conclusion. So I don't think, as far as internal strength is concerned, that it's completely dying right now. So honestly, when I look at this, I'm kind of thinking of it as a buy, not even just a hold. I think if you have it, hold it. But I think that this could be a really interesting buy because you could set that stop up here rather tight. But look at the upside potential. It's really hard to pass that up. And you can see where overhead resistance would lie right around that 1125 area. So I would probably set a stop. Like I said, I think that's kind of aggressive at the 1022 level, but you'd know there's really serious problems if it's going to drop below that 1025 area because you're losing some very long-term support. And that would be a problem, clearly. But I think there's, honestly, it might be that time to put out the hands for the falling knife. What do you think?
Okay, well, I'm going to tell you what I think.
Yeah, and I don't know if it's similar. We have different styles, so it's always interesting.
Here is a 10-year chart on Ford. I'm a momentum trader. I look at this and I just want to throw my hands up in the air. It's like outside of maybe a little pop here or there, this thing has been between $10 and $14 for the last 5 years. Now, it is in the low end of the range, so I agree with you. If I was going to do anything with Ford here, I would be a buyer. I wouldn't be selling just above major long-term support. But I'm also not getting into this with the idea thinking that I've got some kind of a juggernaut to the upside either. The most appealing thing to me about Ford is its dividend, which is about 5.6% right now. So if you're a dividend player, and the way you can, I've done this before, but let me just pull this up. If you go down here and hit full quote, all right, I keep hitting it. There it is. And by the way, I don't know if anyone has noticed the difference in my charts today, but I have got a huge monitor. Been set up now with the different resolution. I'm hoping that my charts are coming across looking much better for everyone. And I'd be very interested when you do the survey to let me know what you think of the charts, particularly my charts, because I have made there have been a lot of changes. But anyhow, if you pull this up, you can see the yield, 5.68%. That is one of the highest yields among the major companies that I've seen, and it's because of two things. Number one, their yield, their dividends have been going up, but also because their price has gone down 30% the last month. Another thing that you can do is you can go down here under indicators and hit dividends. And I'm going to put that up a little bit. Let's increase the height. And let's take a look at dividends on this chart. So dividends for the most part, and of course, Ford went through a lot of issues back during the whole financial crisis that we had. But you can see the dividend has been steadily moving higher. We did pull back. I don't remember that now that I think about it, but it did pull back beginning of 2016. But it just recently went up again, and it's now, last quarter was 28 cents, it looks like. Mm-hmm. So that, combined, you go back, you look at what the annual dividend has been based on the current price, and you've got a yield of 5.68%. That is a pretty strong yield. Now, you don't see the same history that you see on many other companies where there are a number of companies out there who've been raising their dividends for many, many years without these periods where you just kind of go without dividends. I mean, to me, Ford becomes almost non-appealing if they don't pay a dividend, because over 5, 6, 7 years, the stock price has gone nowhere. So, I mean, really what you're banking on are those dividends. So I'm going to say, for me, I'm going to go buy. I'm going to say buy because technically we are near support. But I am not jumping up and down here. I just find it to be an interesting support level. I find a really, I think that the yield is so nice, be good for a dividend, someone who's looking for income as opposed to capital appreciation. But yeah, just not exciting not exciting to me at all. And even if we go to a daily chart on Ford, and let's go a year and 6 months. I mean, this back and forth yo-yo stuff that you see. I mean, it looks good, and then all of a sudden falls apart, and then it hits that support area around 10. That looks good again for a while, and then it falls apart. So, would I be a long-term holder of Ford? Well, again, if I'm income oriented and I'm confident about that dividend, and as long as they keep paying that dividend, I guess you could make a case for it. But I'm looking for more than 5% a year when I trade. I'm not looking just for the dividend. I want to try to make money from trading, from momentum in a stock. And so Ford's really not the kind of stock for me. But as you mentioned, and as I'm sure a number of people in the chat room are mentioning, $10 is a pretty key support area.
Yeah, absolutely. And, if you're trading in a trading range with a low price stock like this, there's certainly some profit to be made.
Yeah. What's the chat room saying? Have you gotten a pulse, taken their pulse?
Well, let's see. So at this point, tallying it up, what would you do? We're both on the buy side, although you're a little less enthusiastic than I am, I would say. And the live audience as well is going with us. They're bullish on Ford. But there were a lot of people who agreed tight stop, that, watch the trading range, things like that. And I think, when you're looking at dividend paying stocks, I mean, it's when things get a little nerve-wracking. I like, if I'm going to have something in a buy and hold long-term account, it better pay dividends.
Mm-hmm. Well, Ford certainly does that. I mean, we got a nice dividend in there, 5.6%. Like I said, most of the bigger companies and some of the financials and so forth. I mean, if you're getting 3.5% on a dividend, it's pretty decent.
Yeah, absolutely.
You're getting more capital appreciation, though, I would say, out of those companies. So, you're giving something to get something,
right?
In my opinion.
Yeah, we did have somebody say that Ford was a day trading candidate. I don't know. I don't day trade, so I couldn't say.
Yeah, I'm not. Again, short-term trading, I want to see momentum. And this one, I mean, it's been very volatile of late, but so everything in the market's been very volatile of late, looking at the charts and so forth. So I don't know. I mean, I'm not a day trader, so I can't, some of you might think I'm a day trader, but I actually like to hold a little bit longer than the day. I don't like day trader by definition is you're in cash when you open the day and you're in cash when the day ends. And that's certainly not me. I will hold overnight.
Yeah. Right.
Usually. I prefer actually during a nice bull market, just hold on for a few weeks to even month and a half. As long as my position performs, I'm fine with that.
That's pretty much my trading style right there. Although admittedly, I am starting to get a little more involved. I'm watching all my Monday setups doing well over the past year. I keep thinking, now, why didn't I do that? So I've decided to start taking the time to get in there and maybe trade a little bit more than once every couple of weeks or months. So
give it a shot. Well, I know we have some questions. There were questions that came in yesterday. I was holding them and thought maybe we'd have some time. And I think we got a couple minutes here.
Sure.
So I'm going to ask you a question here. First question is, any clues as to whether we'll see a V or W bottom? And I guess if you have any opinions as to which would be better or worse and what to look for as to what might set up here, or what do you think?
Right. For me personally, I'm looking for a double bottom. This rally, if you want to call it that, coming out of, I want to look at a chart when I'm talking to you, just so I'm talking to the right thing. But, when I look at the chart and I get a feel for, the rally that really started on Friday, if you want to call it, it's just so anemic. It just doesn't have the excitement behind it of, yes, we've hit a bottom. Now let's go bargain hunt. And I just don't see it. I don't feel it. So I'm expecting the low to be tested. I'm expecting to see a larger double bottom. And I think that would be good in that, those are bullish formations, and seeing one of those come in after such a drop, I think it would be really very bullish. So I'm not expecting this rally that we're kind of starting here to do a whole lot. I need it to go a little bit more just so I can get my short-term indicators from being so oversold. I'd like to see them rise a bit more. But yeah, I'm looking for the double bottom. I would start to get very nervous if we passed that recent low. I would have a real problem with that.
I'm not seeing your chart. I don't know if you've got a chart up.
Oh, no, I'm just talking. Sorry.
Okay,
I'm just talking it out. But yeah, I'm looking for a double bottom. I think that this current so-called sort of rally that started on Friday, I mean, it's anemic, and yeah, I'm expecting the low to be tested once again. And if that is broken in a decisive way to the downside, look out below.
Yeah, I think, and I just pulled up the chart on the S&P, and I'm looking at a weekly chart because I think the daily, it's just there've been so many big fluctuations back and forth. It's kind of hard to get perspective.
Mm-hmm.
I think on the weekly chart, clearly we're in an uptrend. We had been moving up since the end of August, really almost uninterrupted. We pulled back a little bit in the summer, but not much. Kind of sideways consolidated more than anything for a couple of months. But we had an uninterrupted move to the upside, and we've pulled back. I think we're going to have a continuation pattern of some sort. I expect maybe a little bit more of a bounce. I don't disagree with you. Maybe a second low to come back down and test, but maybe a bullish flag, or not flag, but a wedge, something like that, or maybe a triangle. Maybe we'll get into some kind of symmetrical triangle where we don't go back. But I'm letting kind of things play out here, and I'll trade from time to time and keep stops tight. But to me, this market's much different than it was 2 weeks ago.
Yeah, absolutely. Absolutely.
Let's see. There was another question that came in, and I'll take this last one, then we'll wrap up. The question was, on the VIX, does it trade like a stock, with support, resistance, moving average, trend lines, and so forth? I can just tell you my opinion is that the VIX is nothing like a stock. First of all, the VIX isn't based on demand and supply like a stock moving up and down. The VIX is priced based on the premiums on S&P options. So, for instance, when the market starts getting really volatile, if you're an options trader, they get more expensive. When you have the opportunity for a stock to move much faster one way or the other, then the options on those securities are going to be priced higher. And when they're priced higher, that's what the VIX uses to measure the expected volatility going forward. So the volatility index, and I could pull up a monthly chart. I mean, this is not ever going to look like a stock. Well, it may look like some stock charts, but I hope you don't own it if it does, because all it does is it spikes and then it settles down. It spikes and it settles down. It spikes and it settles down, and so forth. And that'll continue doing that. We're not going to get into a situation where the VIX just keeps rising for a couple of years with rising lows, a trend line, that sort of thing. So I think it's just my opinion, but I think it is pointless to try to use technical analysis on the VIX. I think for me, it's just a sentiment indicator, and when it's on the rise, your caution needs to be on the rise as well. I think you have to be real careful.
Yeah, I kind of remember getting news items because there is a vehicle where you can trade the VIX.
Oh yeah,
and people were bouncing into there, and a lot of the trading houses, like I know Fidelity, basically wouldn't let people do it anymore as a protection because people were losing 80-85% on it, on some of those funds that are out there, those big hedge funds. So
yeah, and I think there was one hedge fund that went under just recently, and they cited the VIX, the fact that the market was going higher in January, but the volatility was going higher with it, and they didn't account for it. And so I don't know what positions they had. I didn't read anything about that, but yeah, you got to be careful. The volatility definitely changes the character of the market and the moves to the upside and the downside. I mean, prior to 2 weeks ago, I was looking for these, any kind of a modest pullback, just an intraday move lower, and I'm ready to jump back in. But this, because we have such huge volatility and wide price swings, you can't do that anymore. But
yeah, I wouldn't trade an indicator. I just wouldn't.
Yeah, let's go ahead and get wrapped up here. I know we got the weekly schedule ahead, and I'll let you get in. Oh, and there was another question asking about bear markets, and I think that leads right into the weekly schedule. So
I think it does. So anyway, tomorrow we have Charles Kirkpatrick. I did give you a sneak peek at his book Before the 10 and 10, if you want to check that out. Julius de Kempenaar will be with us, the RRG creator, and he'll talk about that. And then Friday, I will be doing my workshop on bull and bear market rules. So when do we use them? What do they mean? What to expect? So I'm going to talk about that because I think you can use bear market rules even though we're not in, a cyclical long-term bear market. So I'll tease you with that. But Friday, I'll be covering off some of that, as Greg says, covering off. I like that.
Yeah, absolutely. It's going to be an interesting session, no doubt. Of course, again, as Aaron mentioned, we'll have Charles Kirkpatrick here with us tomorrow and Julius on Thursday. So we got a fun-filled week ahead. I do want to thank everybody for being with us today. Please complete the survey. And as I mentioned earlier, if you could let me know how my charts look, I really would appreciate that. We did try something different today with different resolutions and so forth. So I'd like to see how it appeared on your screens. And we just love to get your feedback anyway here on Market Watchers Live. As a reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. We'll see you back here on Wednesday. Happy trading.